What's up, guys? It is Sunday, October 20th. We're going to be looking at a 64-page report from KKR, an American private equity group, but they're a global investment group. If you don't know them, check them out, KKR. Uh, at the end of this video, we're going to be looking at election outcomes and what it means for Bitcoin. Because these days, you can't do an alternative investment and alternative private asset class video without talking about the orange coin, Bitcoin. So that's at the end of the video. If you want to flip around, we'll look at public markets really quick at the start, private equity, venture capital, buyouts, leverage buyouts, private credit infrastructure, that sort of thing in the middle of the video. Bitcoin at the end. We might have a thing or two to say about gold and silver and precious metals. Stick around or check the timestamps below and flip through it. Do whatever you like. All right. This has been getting a lot of play online these days about the unrealized gains or losses on investment securities for the banks and the central banks. Everyone knows the Federal Reserve and the central banks here are caught between a rock and a hard place. They have all of these unrealized losses because during a time of low inflation, when rates were low, they had all these long-term government bonds. Holding sovereign debt turns out to be problematic. How's this going to play out? You can see in the bottom here, U.S. national debt on course to double in just 8 years. 20 trillion as of September 2017 should be 40 trillion within the second half of next year. How is this going to turn out? We have some thoughts on this that are going to be a little bit counterintuitive. Stick around. There is a little bit of the boy who cried wolf complaining about debt. I'm curious what you guys think about this. On the right here, this sharp, sudden spike to the upside at the U.S. Treasury total public debt outstanding. So we're still printing, still finding ways to finance the debt. And this acceleration gets you thinking. And then people spot this on their Bloomberg terminal. They start going, okay, here's the big moment. However, using the nobody wants to work anymore trope, this has always been a problem for business owners. 1894, nobody wants to work. 1905, unreliable. None want to work for wages. 1916, the reason for food scarcity is that nobody wants to work. Okay, and it keeps going throughout time. A little bit of the boy who cried wolf with the debt situation also. It's going to be a gigantic problem if it ever becomes a problem. But if we're all just immune to it, bond traders carrying on like normal, world keeps on spinning, then you can't make this your investment thesis. From the great Wayne Whaley, when the S&P performance goes back-to-back double-digit years, what happens next? I believe the total turns out to be 7 years that were up and 12 years that were down in the month of January, something like that. But the year percentage, let's see, up and down is, what is that in total? We get an average of a 2.9% return the following year. So weakness could be coming. We'll see about that. But it depends. Depends which sector of the economy. We're seeing the K-shaped recovery. The rich get richer, Ferrari continues to do well, poor get poorer, Dollar General gets killed. Is this a trend? Is it wealth inequality? Are things getting worse? Is this socioeconomic structure going to lead to demographic issues and unrest? We will see about that. At the same time, it's a little quiet out there. Too quiet. When credit spreads are compressed, as they are currently, it's good for markets. Until you get so low that it just becomes too good to be true. Credit spreads down, boom. Housing bubble, 0809 financial crisis. We go down. What's it going to be next time? But it's important to note, look at the time frames down here. This is 05 to 09. You can be down here for a couple of years before something happens. But we are starting to see a little bit of a curl to the upside there. So let's keep an eye on Tavi Costa, Crescott Capital, see what goes on there. The credit spreads. So look at us, all the way a full standard deviation or perhaps multiple standard deviations below where we usually would be. So look, when you get down here in 07, suddenly you're back to the top in 08. Is a credit crisis coming? We'll see about that. But like I said a moment ago, it's hard to make that your investment thesis because if your game is to predict the unpredictable, then you might be better off as a psychic than an investor. And this is another thing to keep in mind. Bull markets tend to last a substantial amount of time. If we're in a secular bull market, we've been in it for a couple of years, they usually go, what is this? Almost 5, 4, a little more than 4, more than 7, more than 4, 3.5, a little more than 2, 2.5, 6. Only been in this one for 1.5. Whereas bear markets, back in the day, I mean, this is the 1930s after the Great Depression, they lasted quite a long time. 5, 3, 1, half a year, point 0.7, 1.5, almost 2, almost 2. But more recently, they don't quite last as long. This was this between this COVID, if there was a recession, I'm not going to argue with the technical side of it. But recessions tend to not last as long these days. We'll see if that trend continues, but we gotta wait for this bull market to end first, and I'm not quite seeing a sign of that here and now. So, with that, let's dive into. Wait a minute. I did want to mention this because we're looking at these unrealized losses, the Federal Reserve being trapped in between a rock and a hard place. Our boy Darius Dale, 42 Macro, great trader, great investor, great mind for the financial world. People who are talking about valuations and earnings need to get their nose away from the tree so they can see the forest. And that it's not about valuations and earnings, it's about the fact that the Fed has an asymmetrically dovish reaction function to capitalize the US government in a fourth turning. That is the most important dynamic going on right now in global financial markets. And it's not just happening here in the United States, it's happening all around the world. In other words, they got to print money. And that's what they got to do. So you can worry about earnings, you can worry about valuations, but liquidity enters the system, it reflects in asset prices. Moving into the world of alternatives, high net worth individual was 7.7% allocation to alternatives as recently as 2020, 9.1% in 2022, getting closer to 10% in 2024, and I do think we'll crack double digits 2025 and beyond. Why is that? Because the expected compound annual growth rates are high. 12.9% for private equity, 19.4% for venture capital. Important note here, well, really in alternatives in general, you want to be working with good groups of people that have access to attractive opportunities, that have a track record of great due diligence, of identifying opportunity. My firm specializes in this, so a shout out to us. But you don't want to do this as an individual. It's a research intensive job. And even when you identify a good opportunity, you're not necessarily getting it at an attractive entry price. So keep that in mind. It's not just a spray and pray. You have to really have good advisory groups you're working with. Okay, now hedge funds. We can talk about that. I've spoken of hedge funds elsewhere. I think they get a bad rap. I mean, it's a hedge. Your hedge fund is not how you design your portfolio for returns. It's supposed to be a hedge. Anyway, private debt and credit, 14.5% better than the risk-free return, assuming you don't fall prey to credit risk. But the list goes on and on. There's also opportunity zones in real estate that are tax-free. Infrastructure, tax advantaged, depending how you get invested here. There's tax efficiency to consider as well. So these are good asset classes, to make a long story short. The net percent, are you going to increase or decrease your allocations in 2024? Across the board, put cash to work, baby. Private credit, as rates come down, you want to lock in those higher yields over time. Private equity doing well, infrastructure doing well. Public equities getting some traction, which is good, of course, markets are doing well, but these alternatives is where high net worth really want to put their money to work because the returns are expected to be fantastic, whatever happens in the public world. Now, how do the capital markets look? Liquidity seems to have bottomed in July 2022. We're moving up. The central banks have started cutting around the world, and we expect that to continue. So we expect liquidity to keep moving up and up and up and up, and that's where you make money. You don't want to go all in at this July 2021 period, but you make money on the way up. The earnings before interest, taxes, depreciation, and amortization, also known as EBITDA. The margins for buyouts, so basically in the world of private enterprise, better earnings in the private markets than in the public markets, according to data as of April 30th, 2024. So you can make a case that there is asymmetric opportunity there. I could spend like an hour, or I could write a book about this one, so I'm not going to spend a ton of time here. But looking at a traditional portfolio versus when you get into the insurance assets or adding more alternatives into the mix. So we're looking at this one where you have private assets or insurance assets as a 10% weighting. So instead of 60-40, like a traditional person, You go 55, 35, add 10% into insurance assets, you're going to get a projected higher return at a lower volatility. Like I said, I could spend a lot more time talking about this, but meaning you can get more growth rate, and if things don't go well, you'll get less downside. So anybody would want that, obviously. Pension fund asset allocation, getting to about a third of their allocation being to alternatives, which would indicate that the professional money managers, you're managing money with a serious fiduciary responsibility to perform as well as you can. These, you know, what do we say? You got to put your money where your mouth is. If you believe in alternatives, well, look at what pension funds are doing. The allocation keeps getting bigger and bigger and bigger. Sovereign wealth funds as well, starting to have more allocation to different private opportunities. 32% in equities. What we want to look at? Liquid alternatives. Yeah, that's the one. This light blue here. That's looking to be holding steady. Direct strategic investments looking to be holding steady. So not much to infer here. The data only goes back to 2016. So not the most. What was I going to show? So illiquid alternatives has moved from 13% in 2016 to 22% in 2024. This is interesting. 22%, 23, 22, holding steady here. Illiquid alternatives, so meaning they're willing to lock up the cash. They must be having a high conviction in some of those plays. Private credit, so this is to carve out my own slice here. Others, meaning high net worth individuals, and then we're a family office as well. So 14, 19 makes us 33% here. But insurance companies, professional asset managers, funds of funds, pensions, endowments, and foundations making up a big investor class into private credit. But you can get access to, if you work with a group like ours, for example. The adoption rate, this made it in here just to really highlight the opportunity in artificial intelligence. Still looks to be ahead of us. But I mean, my goodness. Like the rate of adoption. So, for Amazon and Google and Facebook, for TikTok, DoorDash, Uber, for these other services, these software as a service, these big players in the tech space, more of a steady rise. I mean, these are parabolic advances, you could say, but nothing goes as vertically as the adoption rate of AI. That is really, really something to behold. And lastly, thinking about correlation, similar to the idea of having insurance assets in your portfolio to get a higher return and a lower volatility rate, you want a lower number. So how does, let's look at venture capital versus direct lending. So not very correlated. So, if the direct lending, like the shadow banking or some sort of alternative credit, if that doesn't go well, venture capital might, and vice versa. So this is what you want to do. Okay, here's one. A zero correlation between real estate equity and ABF. What does ABF stand for? I can't remember off the top of my head, but that's fine. The global aggregate index versus core infrastructure. Okay, so that's good. Anyway, this is just something to think about when you're building a portfolio, or what a portfolio manager is thinking about when they're building a portfolio for you, is that there should always be a bull market somewhere in your portfolio. You don't want everything to be a one, meaning everything is correlated. So if you do really well, you're going to do really well. But if you do really poorly, you're just getting crushed across the board. Freedom by 40, a great follow over on Twitter or X, says, it doesn't matter if it's Trump or Kamala or whoever the heck else. Election season, Bitcoin tends to do well. Look at 2012, look at 2016, look at 2020, and look at where this is written. Up there in that $1 million. So, will we get a repeat? I think the stars look to be aligning. Here is the daily EMAs. We had a break of structure to the upside, holding steady above the EMA ribbon as we curl up. Things look pretty good here. Let's get a longer time frame looking at this with the Bollinger Bands, with the MACD curling up a crossover here is looking very bullish. Look at how long we had this red. If we start to see a couple of green prints, then boy, oh boy, off to the races. Bullish divergence here in the relative strength indicator as well. And to highlight, when we break above this middle section, this is the 21 on the SMA, when we've done that with a high conviction move above, look at this time at the end, or where's that? Yeah, end of 2023 or start of 2023 or thereabouts, we had this move up. This marked the bottom. We put the bottom in here, came up to the top of the Bollinger Band, came back down, tested, look at that bullish hammer, kept going higher and higher. Then we lost it briefly here, July, or let's call this summer 2023. Came back down, moved back above, and have ripped just about ever since until we've been this consolidation, this sideways move. Now we're back above it with the MACD giving us a signal, with the RSI giving us a signal, with global liquidity increasing. So let's make a price prediction with this parabola to look at what this looks like with the price over time, giving us this nice rainbow. So we had a 72-degree increase to go 60x from 2011 to 2013, 2014, 2015, thereabouts. Sideways price action, consolidation. 65-degree launch angle to go 20x. Sideways, sideways, sideways. 62-degree to go 6x. And now a 52-degree launch angle to go about 3 or 4x. Stranger things have happened. This would put us somewhere between 150, 225, thereabouts. Maybe we spill over to the upside, get to 240, 250. I don't know, man. Gold has added about $7 trillion since September of 2022, so in about a 25-month span, $7 trillion added to the asset class. Could Bitcoin do the same? I don't know. I'm not here to make a call. This is from Koosh, by the way, another good follow on Twitter or X. This is not my call. This is just math. And these numbers generally seem to make sense. This pattern generally seems to make sense to me. So would this surprise me? No, it would not.